Target stock is off nearly 60% from its highs, trading around $100 after peaking close to $250. But here's the catch. It's throwing off 4.5% dividend yield, trades at just about 13 times free cash flow, and still prints about 3.5 billion in yearly free cash flows. So is this the best dividend stock to buy in August of 2025? Let's find out.
This video is for informational and educational purposes only. It does not constitute financial, investment, or other professional advice. Always do your own research or consult with a qualified financial advisor before making any investment decisions.
Let's talk about Target's fundamentals and revenue story. In 2021, Target pulled in about $92 billion in sales. Fast forward to the trailing 12 months, and that figure sits at about $105 billion. Growth might not look steep, but for a mega retailer facing mounting competition and a shifting customer landscape, consistency matters. Here's the thing, free cash flow is where the real story lives. Target's free cash flow margin, which used to hover around 4.5%, has drifted down to approximately 3.5%. Target generates about 3.5 billion in free cash flow annually. Its dividend consumes less than two-thirds of that, leaving room for reinvestment or even future raises. What stands out is how Target reinvests this cash. They pay a reliable dividend and additionally buy back stock, lowering share count and increasing value over time. Now let's compare what Target is valued at relative to its peers. At around 13 times price to free cash flow, Target trades at a fraction of the multiple you would pay for a Walmart or a Costco. Costco trades at around 57 times, whereas Walmart trades at about 60 times price to free cash flow. Target's 4.5% dividend yield becomes even more attractive considering both competitors yield about 1.6 to 1.7%. In other words, for every dollar of cash flow generated, investors are paying 4 to 5 times less for Target. I don't mean to say that Costco or Walmart aren't valuable. They are. But it highlights how dividend and value investors may view Target differently right now. Talking about dividend safety and cash allocation, Target has paid dividends for almost half a century and raised them consistently in good periods and in bad. At 4.5% yield, the payout represents less than two-thirds of free cash flow, leaving enough cushion for reinvestment and unexpected slowdowns. Contrast that with high-yield companies spending nearly all of their free cash flow on dividends, they have little left for growth, debt, or surprises. Target, on the other hand, doesn't rely on growth alone. It generates real cash and has a track record of returning capital responsibly. Let's talk margins. Target's gross margin hovers around 28%, which is stronger than Walmart's 25%. Net income margins, what remains after all the expenses are taken out, is roughly 3.5%, slightly better than Walmart's approximately 2.5 to 2.75%. But here's the kicker. Target is consistently delivering these margins while expanding digital presence and operational flexibility. That kind of margin consistency across a vast store network is no small feat. When margins grow even modestly, free cash flow grows exponentially thanks to operational leverage, and that's where shareholders value compounds. Now let's face the facts. Revenue growth at Target has been modest, but growth in retail today relies on digital innovation and fulfillment efficiency, not just new stores. Target.com consistently receives praise for smooth checkout, hassle-free returns, and same-day delivery options. That's reduced friction and built loyalty where it counts. Now, here are a few risk factors to consider, right? Because every investment has its risks. For Target, it's slow growth, margin pressure, global macro volatility, and the looming risk of an economic downturn. High leverage? Not really. Target's debt levels are manageable. What matters more is how this business performs if inflation stays high or consumer spending contracts. Now, if you take a look at Target's long-term chart, then you'll see that it has been in a downtrend since October of 2021. It seems to have found support between $90 and $100 and seems to be making higher highs and higher lows. Now, of course, Target's next quarterly earnings are scheduled on the 20th of August 2025, and that could introduce some volatility. If the numbers disappoint, there's a chance the stock could fall further, possibly testing its long-term trend line that connects major lows from back in 2009 and 2017. I'm not saying it will definitely fall to that level, but that's a possibility worth keeping in mind. So, is Target the best dividend stock to buy in August 2025? For investors seeking cash yield, capital returns, and lower downside risk, it absolutely belongs at the top of your list. We're not talking rocketing returns, but steady performance backed by billions in free cash flow and decades of reliability. If you're building a portfolio that focuses on sleep well stocks, those that survive downturns and grow over time, Target stands out. Not perfect, not flashy, but dependable and undervalued. If you found this helpful, please tap the like button, subscribe for more no nonsense investing analysis, and drop a comment below. Would you pick Target, Costco, or Walmart for your dividend income bet? Thanks for watching.